Welcome to all our clients. Thank you very much for joining us for this webinar. And I think the world today is, as I say, still very much in a crisis. If you think about different geographies, America, Europe, and Asia, and you think about very specific sectors in those geographies, and you think about very specific companies in those sectors, then I definitely think there are clear winners in this environment, and there's going to be clear losers in this environment. And for Sanlam Private Wealth, as a private client business, obviously our philosophy is very high conviction, very concentrated. And hopefully through this presentation, we will try and make it more clear to you that we're looking for those winners, and we think picking those very specific companies will definitely provide you with better returns going forward. So again, from our side, thank you very much for participating. I hope you all stay safe, and thank you again for still believing in Sanlam Private Wealth. And hopefully we'll give you some answers to your questions in this presentation. So without any further ado, Alwyn, if I can hand over to you for your presentation. Thank you.
Thank you very much, Carl. Good afternoon, ladies and gentlemen. You know, whenever we prepare for a presentation, I think we know more or less what we want to say to clients, and the marketing people, it's their job to come up with a fancy title. And the title is, How Do You Manage Money and Risk in a Time When There's So Much Uncertainty? And Carl explained the uncertainty. And I think most of you would agree that your gut feel is that despite the fact that we've seen a significant recovery in financial asset prices, that on the ground there's still a lot of risk around. Now the question is quite a philosophical one, but I think you as clients deserve a very practical answer in terms of how do we manage both locally and offshore. In Pieter's case, how do we manage that risk? Whenever I struggle with a question, I go back to the investment greats, and this time I went back to Warren Buffett. And Warren Buffett uses a baseball analogy, if you don't mind that I use that as well. And he says, you know, if you think that it is a low-risk environment, then you take the baseball bat and you take a full swing at what he calls the fat pitch. Now, the fat pitch is the ball that has been thrown at the batter, and that fat pitch, if it's a fat pitch, it's a slow ball that comes with a straight directory, and it comes into the striking zone, and the batter can get the ball away. Now, the person who actually framed the whole idea of a fat pitch was a baseball player with the name of Ted Williams, who used to play for the Boston Red Sox for 19 years, and arguably the best hitter of a baseball. Now, what made him successful? In other words, how did he manage his risk? And there were two characteristics, and I think they are very relevant for investment management. The first thing is, Ted Williams was incredibly patient. So you've got 3 strikes, and he waited for the pitcher to make a mistake and put the ball in the striking zone. And he would only hit if that ball is in the striking zone. Then he will swing hard at the ball. So that is the first point. He had patience. But you needed the ability to see up front whether the ball is in the striking zone. So when they actually tested his eyesight, he had phenomenal eyesight. Now for us, when we manage risk and we take a fat pitch, the risk to a large extent rests on the price of the asset. That determines whether the particular asset is in the striking zone and whether we should add risk to the portfolio. The eyesight is really our ability and the work that we do to determine quickly whether we can take on more risk or not. And that is the work that our entire team, the 70 client-facing portfolio managers who are part of the team, and my analysts that work for me and Pieter's team, the work that we do to determine that. So what I would like to do, I would like to refer a lot to what we said in March, and then say, okay, how do we do it now? So, ladies and gentlemen, very briefly, what we did say in March was equities were cheap. So from a South African perspective, South African equities were in the striking zone. Time to add risk. Fixed interest, you would recall that government bond yields went up as a result of the credit downgrade and as a result of the obvious problems that we had from a fiscal position. We also said that we should add to local bonds because the prices were attractive in our multi-asset portfolios. Property, we thought it was a curveball. Prices were okay, but we were not exactly sure about the environment that we had to deal with. And, you know, in terms of local and offshore, longer term, I think you've got to think about how much you should have offshore. From a tactical perspective, we just thought that the rand was too cheap, so not time to take money out. But the longer term, I think, principles should dictate that particular decision. So it was, for us, in short, when we spoke to you late March, we thought that the ball was in the striking zone and it was time to take on more risk. So what has happened? As you can see, if you look at global equities, if you look at the black line, I've indexed it to 100. Market global equity prices went down by about 35%, recovered, and is now 10% off its lows. However, if you look at the blue line in this particular graph, that is the Nasdaq index. Again, indexed to 100 on the left-hand scale. And you can see it came off with the rest of the market. But if you look closely, you will see that the actual level, if my pointer can get you there, the actual level is now above 100, which means that the average price of a share listed on the Nasdaq today is 4 or 5% higher compared to the beginning of the year. And to come back to Carl's point is, if you think about the events that we've gone through and the economic and financial meltdown that we've seen, it is very tough to say that those shares deserve to trade at those particular prices. So that is what has happened on the offshore side. On the local side, the pattern was more or less the same. Equities came down by about 36%, recovered, and is now about 10 or 12% below the highs, or below the levels that we started the year. But I want you to focus, I want you to focus on the black line. The black line is the average price of the bank index in South Africa. And you can firstly see that they lost more value, almost lost 50% of the value, but they never shared on the upside. So what you will see, and it's also true from a global perspective, we are starting to get huge divergence between various sectors, various geographies, and various counters, where some shares remain cheap and other shares have gone up significantly. I'll say more about that later. I just want to give you one or two observations from a macroeconomic perspective, because that is important. But I don't want to give you an economic lecture at all. I don't think the local economic picture has changed at all. We said that the local economy will shrink by about 7.5%. It might even be a bit more. What is important, and the new news that came in, I think, since I've spoken to you the last time, was the fact that the government has announced a stimulation package to the value of about 500 billion rand. And we would hope that that particular package will arrest the vicious spiral where demand falls, supply responds to lower demand, so businesses retrench people. As a result of that, demand falls again, and then supply falls again, and you can complete the picture if you like. What this 500 billion does is it would hopefully get some more money into the hands of the consumer in South Africa that will stop the negative spiral and will ultimately get the economy going again in the second half and into 2021. But for this year, there's no doubt that we will go through an extremely tough economic situation, and ultimately you want the government to step in and create more certainty in the local environment. If we look at the global story, nothing has really changed. The European Central Bank said they expect Europe to fall between 8 and 12%. Most of the analysts reckon that the American economy will decline by about 3 to 4%. And as I said to you in the previous presentation, Johan Rupert says that the economists shouldn't even think about the shape of the recovery. We must think about the entire reset that the economy will need, given the particular fallout that we've experienced now. What makes our life a bit more difficult is the fact that in the short term it is good, but the fact that governments and authorities have stepped in and are starting to interfere a lot with the economy. In the current case, it is good because we've seen significant, and Pieter will give you the actual number, significant support across the world to the economic system, and that will ultimately also is aimed to put an end to the vicious cycle between supply and demand. However, the more interference we get from authorities, the bigger the risk for a policy error and the bigger the risk for us to make an incorrect call, because ultimately we can't assess how authorities will interfere. But in the short term, it will be a very, very tough outcome from an economic perspective globally. And within this environment, one must understand that financial assets trade, and the profits that these financial companies or these companies make within this environment should ultimately determine their prices. So just bear that in mind when we talk about risk again. So I think it is important that we go back to valuations. The one slide that I showed you in March was, if you look at the fallout of the S&P 500, it's lost 34% of its value, which was in line with the average decline of equity prices if you go back to all the bear markets that we've seen since 1928. But what we have seen is that that is now forgotten. And if you look at the global basket, equity prices are only down by about 10%, as if the economic fallout does not matter. And I think it does matter. So that is the first point to make. The second point is we do tend to learn a bit when we look at history. And to my mind, one of the renowned asset managers in the world is an outfit called GMO. And there's a person called Jeremy Grantham who's responsible for their macro strategy. So when Grantham and his team, when they analyzed bear markets in the past, they say that normally you can talk about 3 phases of a bear market. The first phase is indiscriminate selling. And that is exactly what we've seen. What does it mean? It means that it doesn't matter whether you're a growth company or a value company or a cyclical company, the market sells all the categories of shares down indiscriminately. And in the process, for us as active managers, we can buy shares that are firstly cheap and sometimes very good quality shares that are very cheap. So that is the first point. Secondly, there's normally a second phase where the markets start to stabilize. And if you look at this particular slide that I've showed you on the left-hand slide, they've just used, and they went through all the bear markets, but I decided to pick the one that started in 2000 and 2001. It's quite a long period before the equity stabilizes and then they go up. And normally what happens when markets recover, it is the cheap shares that recovers at a faster pace than the expensive ones. And what we have seen, as I've indicated on the very first slide, in this so-called bear market, there for me are 2 differences. Firstly, the decline was very rapid and the initial recovery was very steep. Big difference. Secondly, in the recovery, the value shares still lagged those shares that had growth momentum behind them. So Nasdaq performed better than the rest of the market. That, to our mind, creates risks that we need to address as active managers. So I would like to leave you with that one. So if we look at the world, I want to take you back, and this is quite a complicated slide, but if you can just focus on the 7 number here. In March this year, I said, if you look at our assumptions of the rating, in other words, the sentiment in the market, hopefully in 3 years' time, and the expectations on earnings growth, the prospective returns on those assumptions that we made in March was that global equities would grow by about 7% per annum over the next 3 years. Now you've had a massive recovery, so we did exactly the same exercise to try and understand. And it's not, the 7 number is not an exact number. It's simply a number that gives you an indication what you can expect of this asset class. So if we do this exercise now, and I did these numbers yesterday, you will see that if you use a 14 multiple, which is what we used, or what we used in the first slide, and you say that maybe the market is too optimistic in terms of the earnings expectations, you use a minus 10% to consensus, then you get a negative return of 3%. If you use consensus earnings, you get a return of 1% on these assumptions. So forget about the 1%, but look at the gap that opened up between the 7% expectations and the 1%. So all this tells you is that based on the recovery that we've seen that has taken place over the last 2 months, the expected returns have been reduced significantly, and therefore it is certainly not the time to add more risk by adding to global equities at this point in time. Where we can add value is in the selection of those equities, because there are cheaper equities and more expensive equities. And I would like to leave it there. If we look at the South African situation, we did exactly the same exercise. So when we saw you in March, the prospective returns that we had was 15%. Use the same assumptions now, that prospective return drops from 15% to yesterday's number of 10%. So again, I think that 10% is attractive, but you would agree with me, from 15 to 10 on average for 3 years, it is a significant reduction. But let's say inflation is at 5%, then it still promises, in rand terms, a real return of 5%. So it still deserves exposure to this asset class, but we have to pick the better shares in this particular portfolio. You know, I think for clients, it might be quite tough sometimes when we share these numbers. But if you look at where global bond yields are at the moment, in America, if you buy American government bond today, it only yields 0.7%. So if you hold that bond for the next 10 years, you will only get a return of 0.7% per annum over the next 10 years in dollar terms. In South Africa, at least, you get a 9.4% return should you hold it for 10 years and should you assume that the government can repay the capital. So for us, again, within South Africa, the prospective returns look a bit better. Ladies and gentlemen, that is how we see the world. So in short, to get back to my analogy, the fat pitch happened in March. The fat pitch is gone. It is time that we work better with our risk budget as we see it now. Now, I think it is very important that you keep us honest to our word. So what I've done, I've briefly summarized what we said in March. I said, firstly, we should add to equities. Firstly, we said we will add 2 to 3% in the multi-asset portfolios and then add more. We should reduce the cash holdings, because cash with the interest rates coming down is no longer a decent investment alternative, certainly not for the longer term. And foreign and local, we're quite happy in the multi-asset portfolios where Regulation 28, where the law restricts us to 30%, that we'd like to keep the full 30%. So what did we do? We add to equities. And we add in the multi-asset portfolios probably up to between 5 and 6%, depending on the various mandates. We reduced the cash holdings, and we kept the 30% offshore exposure intact. So I think relative to what we said we would do, we certainly stayed true to our word. So where did we add the equities? If I can summarize the actions that we did, the first one is, it was a switch where we sold Remgro, because we think that we can buy underlying assets, same quality underlying assets at a better price. And we added to Bidvest, which is SA exposure, and we added to banks, and we added to Netcare, which is hospital group. So we we sold Remgro and we bought similar kind of assets, but we think decent quality assets. So that is the first one. So you will see Netcare, we bought in March at 15.87. It's currently trading just around that. Or when I did the slide last week, it was 15.63. It picked up today. There was some news that pulled the share price back. Bought Bidvest, great quality company, paid 160. It's now 150. And then there were 3 stocks that we bought on their own merit. And the biggest, and these were the biggest transactions. Firstly, we bought Anglo American that sold off very aggressively. We bought it at 231. Today it's trading around about 350. So massive appreciation in that one. And in the equity portfolios, we added 3% to Anglos. We bought Bidcorp, which is not to be confused with Bidvest. It's in essence an international firm. The market didn't like the fact that they produce or they supply food into the hospitality sector. Share price came under pressure. We bought it at 200 Rand. The share's trading at about 240 Rand today. And then we bought MTN, which we used to have in the portfolio, sold out and bought again below 50 Rand or around about 50 Rand. And it is currently trading at about 54, 55 Rand. And then Absa, Netcare and Bidvest was the switch that we had when we sold Remgro. The final transaction that we did is we took some profits out of BAT. Now, maybe I must just explain that. So British American Tobacco, we bought at 450. We added again, and at the end, there was almost 10% exposure to British American Tobacco in our portfolios. We've decided, since the share price performed very well in an absolute basis, but also on a relative basis, that we want to trim that and use the proceeds by selling that into buying some of these cheaper counters that we've just mentioned. And at the moment, we sold at about 670 Rand, and at the moment the share is trading just shy of 700. So that is in essence what we've done. And maybe talking about risk and talking about the story and the fat pitch, maybe some of you are very uncomfortable with us buying banks. And I think it's important that I just explain a bit more why we bought it. We thought that the ball was in the striking zone. If you just look at how the share price has responded of all the banks in the banking sector, Absa was down 51%, Standard Bank 41%, Nedbank 61%, and even the blue-eye boy, CPI, which is Capitec was down 37% year to date. The Aussie was down 21%. So these shares came under severe pressure. So for us, the value stood out. And I would just like to highlight 2 or 3 points about the banks. Firstly, it is cheap. There's normally a reason why an asset is cheap. And the big reason is, if you look at the top right of this particular slide, is that the investment community is extremely concerned about the so-called credit losses. Another word for that would be bad debts that the banks will incur in this time of economic hardship. So we say, well, of course, we've done the analysis. We know, although we don't know the extent of the bad debts, we know that the bad debts will come. But we think that the balance sheets of the banks are strong enough to sustain the pressure that they don't need to come back to the market to ask for more money to prop up their balance sheets. Why do we say that? If you go back, if you look at the second bullet point, you go back to the global financial crisis, the credit loss ratio needs to go up by 4 times, not 4%, 400%, from the levels where they were at the great financial crisis before they need to come to the market. We think that that will not be the case. We think that the outcome will be not that severe. And although many people think that a train will hit this particular sector, we think it's in the price, and maybe it will just be a lorry and not a train that will hit the sector. So we think most of the bad news is in the price, and therefore we are quite prepared to take bigger exposure in the banking sector. Now, maybe I must just explain how big is that exposure for those of you who look at your portfolios. On average, if you've got a normal portfolio with us, you should have about 9.5% exposure to the banking sector. In the all-share index, there's 9% exposure to banks. So what we call the active position, in other words, the position bigger or smaller than the benchmark, is 0.5. So the relative active position is not that big, but still, if you have 9 or 9.5% in a sector or a share, you want it to go up. And we think that if we take a 3-year view, that banks will trade materially higher compared to where they are now. Many clients would also perhaps even question the wisdom to add to Anglo-American, because at the end of an economic cycle, these mining shares normally come under pressure. This time we are less worried about it. And the reason for that is, normally in an upcycle, these miners are their biggest own enemies. They spend a lot of money and they forget about the balance sheet. In this case, mining counters actually looked very well after their balance sheet. And if you look at the graph to the right, I will just highlight that. If you look at that brown line, you will see that the net debt expressed as a ratio of the operational profits, it's only 0.5 or half of that. That is extremely low, and if you compare that to 2015, that ratio was 2.5 times. So we think these balance sheets are very, very robust, and the valuation of these shares are still, for us, quite good, and therefore we're quite happy to have added to it. I'm going to conclude, and I'm not going to talk you through this slide, but I just wanted to give you an indication of the kind of work that we've done on all the various counters and sectors listed on the stock exchange, and to try and understand how the economic fallout would have an impact on these shares. So we would look at the immediate impact on the business. We would look at what would be positive or negative for the companies as a result of the fallout. We would look at the key points for the company, whether it will hit the earnings or whether it would be bad for the balance sheet. We looked at the impact on the dividend payments, and finally, whether they would go into financial distress or not, and then, of course, the key management measures. So we've done it for each and every counter that we hold in our portfolios. And once we've done this exercise, we then look at the price to understand whether this ball is pitched over the plate or in the striking zone. So ladies and gentlemen, I'm going to conclude. We've used the weakness in the market to add risk to the portfolios. We added to equities locally, we added to local bonds. But as we see it now, it is now time to sit on your hands. Global equities in particular displayed excessive optimism in terms of, if you look at the recent price increases. For us, it is not time to add more risk. For us, it is now time to fine-tune portfolios to make sure that the stock picking is right when we craft these portfolios for you. In terms of taking on more risk, in plain English, we don't think the movie's played itself out, and we will get opportunities again where the pitch will be fat and where we can swing fully on your behalf. Thanks very much.
So thank you very much, Alwyn, for that comprehensive presentation. We've received a significant number of questions. Some of it is for you, Alwyn. Some of it, I think, is already preempting what Pieter might say. So thank you very much. So I'm going to switch over to our London office, to Pieter Fourie. Pieter is head of our global equities. He manages a high-quality strategy for us. He works very, very closely with our portfolio managers in terms of crafting that strategy with Alwyn, as Alwyn mentioned. And just for those who, just to give an update again, we sit with roughly 80 billion of discretionary assets. More than 40% of those assets do sit offshore, being managed by various strategies. And Pieter particularly sits with more than $1 billion that he helps us manage on behalf of our clients. And so without any further ado, Pieter, if you can just take us through the way you see the world, and then we'll ask specific questions for you.
Good afternoon, ladies and gentlemen. I would just like to stress that when we look at the world that Alwyn's described, it's a very accurate world. Do we think it's surprising in sterling terms that the fund is actually up so far this year. Yes, I mean, I think given the news flow, it is quite surprising. Having said that, Alwyn's thesis around, the fat pitch and whether we, as a manager, you always ask yourself, did you do enough or did you do too much? When the opportunity presented itself, hopefully as we go through the presentation, you will get a sense for, the fact that we weren't paralyzed when those opportunities presented itself. But it's also fair to say that that frame, that window of opportunity didn't last very long. Roughly about 60 to 70 trading days, which is nothing in my life and shouldn't be a determinant for any serious long-term investor. But it is a very volatile, and it's a world where we believe that we can add value if the market continues to be this volatile, given the small opportunity set that we typically look at for our portfolios. When I look at the market outlook, therefore, and just to highlight the impact that the Federal Reserve has had on potentially the market, I mean, I've become a better investor over the last 20 years when I stopped worrying too much about things I can't control. But I think it'd be very naive to think that the impact of the Federal Reserve and that extra 3 trillion of stimulus, which has been given obviously to the wider sort of banking system, and of course directly into the market with their ability to buy assets directly, certainly has helped to stem the negative news flow and also the actual ability of the market to recover. So let's not underestimate for a second that the ability, as Alwyn says, for the Federal Reserve to go through this whole process in a controlled fashion, that the stakes are higher than ever, that this sort of direct intervention is probably not sustainable in the very long term. But it did highlight that, in the words of the Fed governor, they can essentially control in the very short term flows when you've got a loaded gun this big. What matters to us as stock pickers, though, is the fundamentals when it comes down to earnings, because as Alwyn says, ultimately earnings drive performance. I saw on the Q&A question, one of the questions from one of the participants was whether the move in the Nasdaq's not justified. And we can come back to that, because from an earnings point of view, certainly the prospects, if you compare that blue line and the collapse of about 40% for the market as a whole, if you compare that to Amazon, to Microsoft, to Google, and Facebook, perhaps those earnings estimates actually moved up for them. Now it's just a question of whether the market haven't overreacted or has not overreacted in terms of placing a value on that earnings. But collectively, there's been big winners, there's been big losers, and we will see on the value versus growth sectors that discrepancy in the valuation is larger than ever. And of course, as value investors, you want to make sure that whatever you buy, you don't overpay, no matter how good the quality of that business is. But there are very few businesses in this environment that will not have some sort of earnings suffering, certainly over the next few quarters. If we look at our earnings and our portfolio, I just had a look at our total portfolio positioning. We reckon our portfolio is trading on 17.5 times earnings for next year. Is that expensive? Well, I've lived through 2000, 2007. Now I'm living through the third crisis. Maybe Alwyn's had 4 or 5 crises in his life. It doesn't get easier. But you certainly have to look through this year in terms of earnings as a non-event if you want to believe that the market is on a sustainable path here. And as Alwyn says, it's just difficult to see a lot of extra upside in the very short term when you've got such a big gap between earnings and the price of the index itself. Furthermore, when you look at growth versus value, there you can see the market's already rewarding growth stocks significantly. It's at an all-time new high if you believe 15 years is statistically significant time period. We are value investors. We are what we would call large cap blend equity. So we have a combination of pure growth stocks like Facebook and Google. Facebook being a great example of a business we bought into just shy of 2 years ago, and the stock's now up 40% in essentially a flat market. But almost 90% of that return came from the end of March. The stock's up 39% in US dollars. That is the sort of name that's been priced very highly by the market collectively. Having said that, it's actually at a discount to that enterprise value to EBITDA for the sector as a whole, and hence we still continue to hold it. What we are not necessarily interested in is the low valuation point for value stocks. It's certainly been in a sort of tight range for the last few years, but we also believe, and it's a very gross generalization, but you've got to be very careful in which sectors you want to be invested in. We'll touch upon that in the next few slides. And I'm going to jump straight into that, because when you look at year-to-date sector returns, I've highlighted there on the slide for you those sectors that have performed well. This was up to the 10th of May. This gap between the likes of the communication services, consumer discretionary and consumer staples, and in particular information technology, as Alwyn said, Nasdaq's up 6% now year to date as of yesterday's close. Certainly there's been a dreadful underperformance from some of the other constituents sectors in the world index, to the point where when I started my career 20 years ago, energy was about 15% of the world index. Today it's 5%. So it's the market ultimately rewards growth in profits. As I say, it's just a question now of whether technologies run too far. But in the very long term, our very strong outperformance clearly was driven in no small margin to the impact that we also had in being positioned in the right sectors. It's just a reality that, over time, for the last good 10 years, that some sectors have just performed a lot better than others. Whether that will continue, we will have to wait and see, and we will explain how we've repositioned the portfolio over the last 5 months on your behalf. So just to highlight again, the fact that we have a small watch list from where we pick stocks means that sometimes we get an opportunity. We waited for 7 years to invest in SAP, and we had a very short love affair with this name because of the significant bounce we've had in the name. We've waited for 4 or 5 years since we disinvested from Accenture and then invested, and we had a very short love affair with Accenture as well because of the significant bounce in the stock. But then we've waited over a decade for Heineken, and we're very happy that that plus Novartis are 2 brand new positions for us, companies that we've watched for a long, long period of time. And it's a function of being focused in what you're doing, not trying to analyze 2,700 stocks, but try to be an expert in those companies that you believe have the ability long-term to outperform the market significantly. Very important slide here, and I'm going to try and run through this in 2 minutes. I will focus first on 2 new positions during the year. I've highlighted that in my fund commentary, which hopefully you receive. And if you want an update on that, I think there's about 700 participants today. It does get sent out to quite a wide audience, but feel free to contact us if you want that update. And we highlight there that we've sold Accenture. So on the one block, in the blue block versus the black block next to it, you will see Accenture was bought, SAP was bought, both were sold. Alwyn was sold as it was bid for by AbbVie. The actual takeout price, the day that the deal closed, Alwyn was at maybe $1 higher than where we sold it. You've got a combination of AbbVie shares and Alwyn. AbbVie remains on our watch list. 7.6 times earnings on a 10% free cash flow yield could be an interesting stock for us to look at. And then Heineken and Novartis, more recent additions. Accenture, I will talk about that further on. Bought in the mid 150, sold at 195, 25% gain. SAP at 88 euros, sold at 115 for 25% gain. And they are some of our big contributors this year. Clearly, if you're making 25% in a down market, you would expect it to contribute to our performance. And then in the case of Heineken, we bought at 74 euros. The stock's trading at 84, and the euro is quite strong as well. So we've made about 15%, but it's early days. Even a name like Heineken, buying at 6.8% free cash flow yield. If you've moved up 15%, that free cash flow yield's down to about 5.6%. I mean, it's clearly a lot better than buying a US 10-year Treasury bond, but that's not a valid argument to compare it against the bubble asset class. But we find that typically if our portfolio is between 5.5% to 6.5% free cash flow yields rather attractive, we reckon it's just below 6% based on next year's earnings, which is relatively attractive for us, but certainly not as attractive as perhaps 6 weeks ago. Then on the position increases, Diageo was very good value at £23. We made that a top 10 position by quadrupling up on the position size at that point. Went back to 29 and we've already reduced it again. Alphabet, we got a good opportunity at $1,100, currently at 1,400. Facebook, we added 142 and 152. It had a 56% rally from the low, unbelievable. And the business looking very solid. And then Intercontinental at £28, we bought more. That's currently 42. General Dynamics at 125, currently at 155. And we think the main area of concern around Gulfstream is being addressed as the market gets more comfortable that no doubt some of us will fly again in the future, no matter what my wife says to me. I think that a lot of the hysteria around travel-related stocks probably reached a crescendo about 6 weeks ago, but some of them have really lifted significantly, including our position in bookings, which have lifted by more than 40% from the lows. And then on the decreases, most of these decreases in position sizes happened early in the year. Reckitt, Johnson & Johnson, Fresenius, all healthcare related. They performed really well before the market started to make a bit of a U-turn on a relative basis mid-May. And 10 cents up over 30%, along with Facebook and Google over the last year. And a good example of those three stocks that performed much, much stronger than the overall market return of 6.8%. And we just felt at 430 Hong Kong dollars, pretty fully valued now. And we will probably put an order in today to reduce that tomorrow morning a little bit more to about 2.6%. It was as high as 4.5% of the portfolio. So performance-wise, it has been a very good relative performance for us at the end of April. The world's moved on very swiftly. In May, in sterling terms, the market was up 7%. We were up 5%. In dollar terms, we were up, I think, 3 versus 5 for the market. So that gap's closed to about 2% outperformance year to date. Could we have done even better? I mean, I think it's important to be intellectually honest. We have suffered from some big drawdowns in ABI, Intercontinental, Sabre Corporation, but the 5-year number is very, very compelling for us, compounding at 8% versus 4% for the average fund and 5.8% compound for the market as a whole. So very, very happy that we finished the last 6 years in the top sort of 12% of all global equity funds. And Rand returns, of course, reached a new high in April. The Rand was very strong in May. We have, by buying into names like Heineken, you ultimately get exposure to emerging market, consumer-related spending power because of exposure to regions of the world like Vietnam, Mexico. There is this very, very fat pitch potentially, as Alwyn was talking about. Are you brave enough after magnificent Rand performance from the fund and from global equity markets versus the JSE? Are you prepared to sell your Amazon and buy Netcore? I mean, that would be an utterly extreme example of the sort of fat pitch that potentially exists in the market today. Our job is to focus on the offshore market, make sure that we don't overpay for quality names. And, given that the fund has performed at 17% compound over 6 years, that's probably as good as it gets in the short term. But there's no reason we can't continue to perform if we remain true to our philosophy of not overpaying for stocks. There's your strategy performance over the long term, outperforming over various time frames. We haven't seen over the last decade any sort of meaningful pullback until recently, and on a one-year basis, you can see there. If you roll forward 1 year from now, the market's actually up 6.8, and we up 5, so we're slightly underperforming. But it just shows you that in order to get the long term right, you obviously need to be a little bit different to the world in general and to the average investor, and that we've certainly achieved in no small feat. In terms of portfolio analysis, it's such a volatile market. If you look at our top 10s there, it used to be dominated by those three companies as good examples of businesses that actually did really well for us in the long term. Alphabet has quadrupled from where we first invested in early December 14. Facebook grew to a big position size for us. We invested in 28th of July 18 the first time, around 170, added at 135. Trimmed at 200 and added again at 142 and 152. But we have reduced those position sizes during May, along with Fresenius, along with Diageo. We find that along with Records as well, in fact, and all of them have moved out of the Fresenius, Diageo, and Records have moved out of the top 10. And what's moved in are names like Bookings Holdings, as well as Bayer Corporation has moved up on the scale. It's up 5% today. We believe that if we have a bit more cyclicality in the portfolio now, that's where most of the repricing in the market hasn't happened yet, as opposed to a name like Fresenius and Records, which are trading at, in some cases, at 22 times earnings. And we just believe that, we're better served playing the recovery themes in names like Bookings and Intercontinental versus buying an expensive defensive business now. We've also noticed that Records trading at a big premium to Unilever, biggest premium in a decade, and Unilever is one that we've been adding to last week based on 17 times earnings for next year and close to a 3% dividend yield. That's rather attractive for us in a low return environment. So attribution-wise, no surprise, dominated by tech stocks and healthcare names. I'll talk a little bit about SAP and Accenture later on, which we've sold. You can see there the gains. Now, taking into account that over the last 6 years, 23% was about the average return of your average global equity fund. So we are not short-term investors, but in a low-return environment, intrinsic value calculations often don't leave us with a huge margin of safety after a big bull run we've had over the last decade. So we will stay very true to our philosophy of exiting a position where it significantly exceeds our intrinsic value. And hence we sold SAP and Accenture. On the bottom performance, we're hoping that the emerging market exposure and all the bad news around the collapse of the travel industry, Intercontinental Bookings in particular, as well as General Dynamics because of Gulfstream, that those stocks have already started to behave a lot better over the last 2 or 3 weeks as the emerging market currencies in particular comes back a bit, as the news flow improve around the opening up of the economy. But it is early days, and there's no doubt that fundamentally these companies have taken a knock. And it just shows you that even when you believe you're buying into a great business, you've got to be very careful, because what ultimately led to the downfall in the likes of ADI in particular and General Dynamics is just the extent to which some parts of the business get hit when it's a complete, shutdown, and which is ultimately a black swan event. Just on my case studies, there's the valuation graph of Accenture. You can see the big spike down. I was just during Alwyn's discussion, I was also going through an article with one of the research houses that we've been working on for over a decade. There's been some announcements around the big four consultancy groups, Accenture and Cognizant, or accounting groups, about staff layoffs. In the case of Deloitte's 5%. We think the news flow will ultimately get worse. And given the fact that stocks had such a big bounce, close to 40% from the ultimate lows, if you were fortunate enough to buy at 140, a lot of that valuation advantage that we had has been taken out with a PE bouncing straight back from 17 back to 25, and time to exit that position. On the flip side, though, a name like Heineken, which we believe the earnings volatility will be hopefully a lot lower over time. You can see very elevated valuations for quite some time. So we've been patiently waiting for an opportunity into Heineken, and that happened close to the, I can't actually see the date on there, but we entered that position on the 17th of March at 74 euros, currently at 85, and ticking up nicely for us. It's not going to be a fantastic grower. You can see their top line growth of 4%, but when we're buying into a position at 6.8% free cash flow yield, we believe that's much, much more attractive than many other asset classes available in the world. And if our forecasts are correct, we believe you can get a sustainable 7 to 9% return profile from that position, from where we bought into. SAP, very much in the huge enterprise software market. They're starting to announce last week at a tech conference that they're seeing a dramatic slowdown now in the US. The US has been clearly a laggard versus, and on the face of bad news, versus Asia and Europe. And what happened was when we bought into it at 88 euros, that discount to some of your more high profile, high growth, nimble companies in that same industry, the likes of Adobe, Intuit, Workday, Salesforce. I mean, these are companies we'd like to own, but they trade at very low free cash flow yields. We had an opportunity at that above 6%. It was the best entry point for over 7 years, but the gap closed so significantly. And to me, it's instructive how the stock seems to have stalled at around 115 euros, which is where we exited for 25% gain. Unfortunately, I think it's worth 105 euros, so doesn't in our view remain a position we can hold for the fund. There's our valuation discipline for you. In summary, we this earnings that price earnings ratio by Q1 of 2020 clearly was the lowest for the last 5 years. The market was also low, and I remember the markets moved up a good probably 18 to 20% in US dollar terms. So expect the actual valuation therefore to move up probably closer to the 17 times earnings that I was talking about earlier. But we're still very happy that when you look at some of our top 10s like Bayer, Samsung, Bookings in particular, those three companies, if you believe next year's earnings numbers, they could be on 8 to 9% free cash flow yield, and that's why the top 10 positions in the fund look very differently to a year ago, where perhaps you still saw the Microsofts, in some cases perhaps even a Visa or a Johnson & Johnson in there. That's not the case. We believe that in this environment, if you are prepared to look out further down the line, then you should be positioned a little bit more with a cyclical tilt. It's not because we have any crystal ball as such, but we just believe that cyclicality is still being punished a little bit. Those businesses have had their own problems for a variety of reasons, but it means that we can get the valuation more attractive for you as the investor. So that's just the summary of our team. At 1.5 billion, we've got a lot of support from Sanlam in terms of our positioning here in the UK as well. We haven't expanded the team, but we've got great plans to keep investing in our research capability on behalf of you, the investor. And there's great support, as I said, from the wider group as well. And thank you very much for those investors who are on the call today supporting us. We hope we can continue to perform for you the way you would like us to. And with that, I'll pass back over to Carl.
So, Pieter, thank you very much for that comprehensive presentation. I'll ask you one specifically to shares, and then I'm going to ask you a bit of an industry or world markets and the US politics a little bit as a question. So first question is, my understanding is that the NASDAQ, this is from Raymond Skolke. So Raymond, it's nice to see you participate, an old colleague of ours. My understanding is that the NASDAQ represents many tech-related shares. Would we not think that broadly those are the winners in a new COVID environment and obviously in the new world? So why are those seen as expensive at the moment? So why do you not include shares like Apple or Amazon in your portfolios?
Yeah, thank you, Carl. I've given the update for May, and I've highlighted the fact that if you look at the 6 best performing stocks by contribution in terms of index weight and absolute performance, 70% of the return over the last year came from Amazon, Nvidia, Google, Facebook, Microsoft, and one other that's slipped my mind now. But the reality is that we own 3 of those 6 names, the likes of Facebook, Google, and Microsoft. And when we look at the attribution of our strategy over the very long term, it's no surprise that our main contributors to performance are the likes of MasterCard, which we don't own at this point, Google, Microsoft, Facebook currently, because we bought that at very attractive levels 2 years ago. So I think my short answer is that we are watching those companies very carefully. We've always had a big overweight position in technology. It's been a very consistent theme for me over the last 12 years of the strategy. We are value investors, though. So if you think we're going to buy into Netflix at a 1% free cash flow yield with a horrific balance sheet, and that is not what we're going to do. I think the risk is that a strategy where quality at any prices work really, really well has been rewarded now for a while. We think that our very strong outperformance was done in a very intellectually honest way, where we're buying into boring businesses as well, like a Johnson & Johnson, which have gone up 150% in sterling versus 90% for the index over 6 years. There are many ways in which you can add value without just buying into technology. But of course, the temptation is to say, well, you know what, I'm going to throw my hands up in the air and only invest in technology. We want to do that when the timing's right. We were very close to buying PayPal back at around $90. We were very close to buying back into MasterCard at $200, but instead we went with SAP and Accenture. So you can see our inclination is to buy those growth businesses. If the market continued to go down, you would have expected us to be buying even more technology businesses. That's what we would have done. In the very short term, we're actually just trimming them now. Again, Microsoft being a good example in the portfolios in the fund. We did that at 184. So Microsoft is in there. It's just not in a top 10. It's sitting at 3% position, but that's been one that we've held for over a decade.
Thank you, Pieter. So then one more question for you, Pieter, before I go. There's lots of questions on Sasol. So for those who ask those questions, we will get back to that question for Alwyn. Pieter, for you, it's a little bit more on politics. So what effect would the unrest in the US have on local US and world markets? Do you believe Trump's election is in jeopardy? And if so, what effect would that have on world markets?
Look, I think we were quite vocal in 2017 when we started talking about tax cuts in particular, because one of our competitors a decade ago had a great article about things you can control and you can't control. Now, obviously, I can't control Donald Trump. I don't think anyone can control him. And I hope the North Korean leader don't try to control him, because, whoever knows what he will do. But what I do know is that the payback for the business community in terms of this 7 trillion of liquidity that's been pumped in by the Fed, there's a payback due. And the risk is, for me, that the tax rates go up from 21% to 29%. It's something, that was highlighted by a strategist yesterday, that will have roughly a 12 to 15% earnings impact on its own. And the market in the beginning of 2018 was very quick to discount the tax stimulus that Trump actually put through the economy. I'm not going to comment about him as a person. It's not my place. I never comment about any politician on a personal level. I think of what a politician can do for me in terms of making the economy better. That's how I look at politics. And Trump was definitely good for the U.S. economy. But has he overplayed his hand? And that is the risk, is that I think whoever is going to get into power, it's probably not going to be him. If it's the Democrats, you're looking at more, concerns around healthcare. You're looking at more concerns around tax and how we're going to increase that tax rate. So we're a little bit on a hiding to nothing. In terms of unrest in the cities, it's really not. To me, that's a non-event in the short term. It's awful what's happened there, and it needs to be fixed. But that is down to the politicians to do that. I just think that come September, October, November, the prospect of higher tax rates overall, no matter who's in charge, will be the issue that will start to worry the market perhaps once the election's done.
Okay. Pieter, thank you very much for that. I'm going to then move to the local side, to Alwyn. So Alwyn, there's... I want to start with, again, as I said, there's many questions around Sasol, but I first want to get a little bit to a very common. I want to combine two questions basically into one. So a question from one of our clients: what is your suggestion for clients recurring income from their portfolio, dividends being slashed and money market interest also unwinding rapidly given the rate decline? And what are your cash and near cash positions? And then a question that was similar to this, like, should we not just invest in the retail investment or savings bonds? What are the returns there? And is that not a good strategy? And maybe if you can combine those two questions, because I think it's very pertinent for our clients who need certain drawdowns on a monthly basis for living expenses.
Yeah, I think clients in the first place must simply just accept that your sources of income, all of them, cash, bonds to a lesser extent, and dividends, all three of them have had a negative hit. And therefore, if your capital remained the same, there's no alternative. If you take the same proportion out of your portfolio, or if you rely on that income, it will be lower. I mean, you can't get away from that. But I think what we need to say is maybe we can relook at those building blocks and say, can't we reconfigure those building blocks to come up with a better solution for me as an individual? And those building blocks will differ from person to person. So my suggestion is, because it's such a unique question and a very good one, by the way, that when you depend on your income, that you actually engage with your client-facing portfolio manager and see if you can come up with the best solution where you combine risk, return, longer-term growth, and income to make sure that you come up with the ultimate solution. I just want to come back to the retail bond. The retail bond, a 5-year retail bond, now, if my information is correct, would yield 8.5%. Now, 8.5% when inflation sits at 4 and might even drop below 4 is still a pretty decent real return. The risk with that 8.5% is the balance sheet of the government or the fiscal issues. So with the fiscal problems, that is the reason why that yield is still pretty attractive. But I think in the short term, one can work through that and without putting all your money into a retail bond, because then you will incur certain risk. And, I don't think it's a sensible solution. It certainly must be one of the building blocks when you create an income solution for a client. And that 8.5% per se is quite attractive.
Then we can come to a question, though. This question, I think, was asked probably 7 or 8 times. We received more than 20 questions. So, Sasol. Question is, should we increase our exposure in Sasol? What's the reason for the significant increase in the share price over the last month or two? There were obviously significant risks in Sasol before. And if you could maybe just give an overall view on Sasol.
When you look at Sasol, and now I'm going to answer the question from a long-term perspective, because we had exposure to Sasol, and then the share price came under absolutely severe pressure. In fact, the share price fell all the way through to 22 Rand per share. And many clients, and in fact our colleagues, would suggest that why didn't you buy more shares when the share price was at 22? But maybe we should just revisit the conditions of Sasol at the time when the share price was at 22. Firstly, we had exposure to it. We had an overweight position to it. And at that time, Sasol's gearing was in peak territory. And that was a time when there was negative oil prices. The demand for oil fell apart as a result of the virus. And there was a battle between the Saudis and the Russians in terms of production cuts. So it was an absolute perfect storm. If Sasol didn't have a balance sheet problem at the time, we would certainly have recommended that we should add to the portfolio. But at the time, Sasol was breaching covenants in June and for December with the banks, which means that they would have been a forced seller of some of their assets at exactly the wrong time. So they have clearly indicated, and we were in constant communication with them, clearly indicated that they would need to find $6 billion somewhere. $2 billion they reckon they could gather by cost savings. $2 billion, if they were lucky, in terms of a capital raise. And then $2 billion if they can sell some of their assets at Lake Charles. But you can understand that in this kind of environment, to put an asset up for sale, there was a risk that they can't get a proper market value for those assets. So we had to build that into our decision-making framework. And then, of course, if the oil price is not going up, it would just have dire in the short term, because the balance sheet issue is a short-term issue. It's not a long-term issue. So if you can't survive the short term with a low oil price, the company will go bust. That is how severe it was. So we didn't want to take that risk. And we always said that the outcome might be binary. So we said that we would much rather than sit on the sidelines with our holdings, and then when they come to the market with the rights issue, we would like to follow our rights. But by then we would have more certainty. For clients who had no exposure to Sasol, and that were prepared to take on the risk that they might actually write off the 22 Rand per share if the company goes bust, we said, well, under normal circumstances, the share price, the value that you put on the share price is much higher than the 22 Rand. But it's again, was it a fat pitch? And given the fact that we thought that it would be a curveball, given the information that we had, we never thought it was a fat pitch, and that is why we stayed out. If they come to the market with a rights issue, depending on how much they want and at what price, in all likelihood, we will follow our rights. So some clients, I know that we traded a lot of Sasols for clients that were prepared to take the risk. They smile today. The share price is now trading at 113 Rand. That is great news. The actual value under long-term oil assumptions is much higher than the 100 Rand. But in the short term, the issue was whether the balance sheet would have been robust enough to see them through this very difficult time. And then we never got a clear answer on that. And with clients' money, I don't think we could have taken the risk by adding more to Sasol at the time.
Okay, thank you, Alwyn. I'm wary of our time, so I'm going to ask two more questions. And for all those individuals who did ask questions, we'll get back to you individually on answer those questions. Alwyn, resources. Yeah. So our exposure, we don't have compared to the industry, I think we're a little bit underweight in resources. What's your view on resources? And specifically a question on gold. And then and then maybe if you can, then my last question, if you can answer that as well, is that I think it's a very, very good question from Graham Miller. How will the world's new image of China affect international investments and trade going forward?
Okay. Can I just answer the question on resources? My own background is one where I do macro analysis, and over the 30 years that I've been working in the industry, I've always learned that you cannot ignore the economic cycle and the commodity cycle when you decide on the amount of resources exposure that you have in an equity portfolio. So you would normally find at the end of a cycle that you should have less resources exposure in your portfolio. And if you look at what we have done, we've done exactly the opposite. We sit with more than 7% in Anglos, and we sit with almost 9-10% in BHP Billiton. So just in those two counters, we sit with 17% exposure, which is higher than what we would normally have. And I explained the reason why we have Anglo, so I think it explains it. And the reason why we have higher exposure is that generally, mining producers have acted far more rationally this time in the cycle. They didn't dig more holes in the ground to utilize the higher commodity prices. They addressed the balance sheet. And as a result of that, the fallout in commodity prices was less severe this time than in a normal cycle. Hence our higher position that what we would normally have held. But we are underweight platinum and we are underweight gold. And both those calls are hurting us. On the gold one, I'm less worried about. And I will always say to people when they ask the gold question, you get two kinds of people who like gold and people who don't like gold. Now, I shouldn't carry any biases, or we as a team shouldn't carry any biases into an investment decision. But what we find over time, over the long term, gold shares hasn't really added value. And I've done the exercise myself where I looked at gold shares versus the diversified miners, which are Anglo and Billiton. And I've done it, I think, since 1992. And there were only brief periods over that, well, almost 30-year period where gold shares outperformed the diversified miners. And that was normally in a crisis. Now, we've had the crisis now. So we have seen the response to the gold shares and they've outperformed now. So to now, after the event, buy into something that has performed well doesn't make sense to us. So if you could have forecasted a COVID-19 pandemic, we would have included gold. Now it has happened, and I think you will do much better by identifying assets that will benefit when the economy turns and where the valuation is low. So we are quite comfortable with our position as far as that is concerned. On the platinum side, it's a bit more difficult because the palladium price is very high. I think to some extent the price, it's an interesting one because the palladium price is high because we've got COVID. People can't get down the mines and mine the metal. But on the other hand, car sales have fallen off a cliff, yet the price still remains high. Those prices, the share prices are trading at fair value in our mind, and therefore we have debated the platinum case extensively and decided that it's kind of 50-50 call, but decided not to add at a very late stage. And that is exactly why we've added 3% to Anglos, because there we got the exposure of Anglo Plats in Anglos as well. Then the question, and I'll be very brief about it because it's a very philosophical question. It's one that personally I paid a lot of attention over the last week. For me, remember last year, the market sentiment changed continuously in the process when we had the whole China-US trade sensitivities. And what has happened, initially when the trade negotiations started, the Chinese were simply wrong. And the rest of the world had sympathy with America and the way that they wanted to address it. But because Trump was the orchestrator, he started to lose the moral high ground in this whole process, and the world started to turn a bit against the case for the West. What has happened in recent months is that China is starting to show a much stronger and authoritative hand, and they are now starting to lose the moral high ground. The net result is that international trade is likely to suffer. So the good work that started after the Second World War, where international trade was, increased significantly. If you look at those long-term charts, you can see how it is starting to roll over. And that will have longer-term negative implications for the world and also for inflation, which worries me. So it's not something that bothers us today, but it is something that we need to take into consideration when we construct portfolios. In the short term, I am very worried about the intensity of the trade tensions that are likely to follow. Just to give you an example, Carl, Donald Trump has said that In fact, not Donald Trump, the Australians, in a recent article in the Times, suggested that the G7 should meet with South Korea and 2 other countries, it's escaped my mind now, where they will discuss how the world should address the G5 rollout without being less dependent on the Chinese in the process. And that for me is not a good sign. They might be right, but it's not a good sign for global trade. So I think it's a very good question and something that we will put in our pipe for longer term perspective.
Thank you very much, Alwyn. Pieter from our London office, thank you very much for your presentation. From my side, as head of this business, I still believe, and I said that also in March, that I think the world will recover a little bit faster. I think South Africa is going to take a much longer recovery. I don't think we have the firepower to do what the rest of the world has done. But within that, I think there are still some opportunities for us. So again, thank you very much for taking the time to be with us on this webinar. I can assure you from a Sanlam Private Wealth perspective, it's business as usual for us. We're fortunate to be one of those industries where we can carry on working in a very, very normal environment. For you, our clients who need to draw down on a monthly basis or are very, very dependent on the growth in their portfolios, we really, as I said before many, many times, we feel your pain. We're going to do all our best and everything in our power to make sure that we have the right decisions, that we debate these decisions, that we make the right calls for your portfolios between South Africa and offshore. So again, from us, thank you very much for your patience with us from an investment perspective. Thank you very much for your business. And I hope you all stay safe out there. If you still own businesses, I hope it's going well with your businesses and that you can see through this crisis. And we'll do another webinar probably within another couple of weeks. We can just give you an update again on trends and the way we see the world. So again, thank you very much for your time.